everyone, for your time this morning. As Emily said, I'm going to be speaking on the interest rate risk management side of things. Just wanted to provide more of a market update to folks around what we're seeing in the markets today. Also, talk a little bit about the Liveboard transition. I know that's something that's been pressing out in markets, and feel free to ask some questions about it. I'm going to speak about 15 minutes this morning on the interest rate markets and different things that we're seeing clients execute in the current market. So, like Emily said, feel free to throw in questions that you have. I do want this to be more interactive, and I do want to target it more towards what your expectations are and what are the things that you need or desire to hear about on the interest rate risk management side. So, I've got a couple of slides here, and I'll kind of run through them, but it's not going to be anything that we're reading off of necessarily. I've got some graphs and charts just to talk about what we're seeing in the markets. But since the beginning of the year, if you look at just Treasury yields, you've seen the 10-year Treasury yield jump from 91 basis points all the way to as high as 177. Today, we sit right around 160, 165. And part of the reason why you've seen such a strong, drastic move on the longer end of the spectrum, even though the Fed and shorter-term rates have been anchored near their lows, is with the big buzzword. If you've been watching CNBC, Fox Business, or Bloomberg, you've heard this word pretty frequently, inflation. And with inflation and the expectation of inflation, the question is what will happen with monetary policy? If you look back over the last few years, or last year, I would say, just after COVID, with the amount of stimulus that's been adding, not only by the Fed, but also on the fiscal side of things, the Fed's balance sheet itself has increased from $4 trillion to $8 trillion, so that's doubled. And then on the fiscal side of things, you've seen the CARES Act that was $2.7 trillion or $2.8 trillion when all was said and done. You saw the end of the year omnibus bill that was around $900 billion, and then you've seen the American Rescue Plan, which was another $1.9 trillion. So put that all together, and we've got about $6 trillion of fiscal stimulus that's been added to the economy. So you've got $4 trillion of additional Fed balance sheet that's opened up, additional $6 trillion from the fiscal side, and now we're talking about an infrastructure plan that could near another $2 trillion. So with all of that that's been added, inflation has been a huge buzzword, and clients, large and small, have been coming to us asking us, what should we do with where are rates going to go? What should we do? How should we manage? And the message from the Fed has been pretty consistent. The message from the Fed has been that we're going to keep rates on hold until we see some longer-term inflation. Right now, they see the inflation that we've been seeing as another buzzword, transitory. Based on where we were last year, if you look at year-over-year numbers, the feeling is that, of course, with how depressed things were, that inflation numbers would be significantly higher than we've seen historically. The PCE, which is the main Fed measure of inflation, came out last week at 3.1%. The Fed's target range for where they would like to see inflation over a long term is at 2%. So we are seeing those numbers, but the question is whether that will be or whether that will extend over a long term. So right now, the Fed has been saying that they expect rates to remain on hold for at least another year, maybe 2 years. And as a result of that, shorter-term rates haven't moved, but the market isn't necessarily believing them. We're seeing a lot of reopening strength. We're seeing employment start to come back. And the question is whether with the rollback of the unemployment benefits that are happening by the states, starting in June and July, whether that will bring more and more people back to the back into the workforce. We have the employment report tomorrow, which will be a good gauge for how employment is trending back. Unemployment right now is at 6.1%, but one good measure is how many jobs from the pre-pandemic highs are we, and that number is right around 8 million. So we still got a pretty good gulf on the employment side of what the Fed feels like we need to fill in order to see a true turnaround. So right now, the Fed has, like I said, anchored rates closer to zero and expects to keep it there, but the market isn't necessarily agreeing. a couple of slides in here in this presentation. This just goes back to what I was saying a second ago, the increase of the Fed's balance sheet from right around 4 trillion to 8 trillion, the largest Fed balance sheet that we've ever seen. And this is another chart. Here's the Fed's new inflation framework, what they expect. They expect and have a target for inflation at 2%. Right now, we haven't gotten there. But we did, like I said, see a 3.1% in this area last month. So we're above that target. But how long will we stay above that target? The Fed has said we want to see sustained inflation. So we want that number to be above 2% for a while before we make any adjustments to it. Now, the first thing that the Fed will do is they will start to taper this balance sheet before they tighten monetary policy when it comes to the Fed funds rate. So you will see this number start to trend down. And when that tapering conversation happens, you probably will see longer term rates increase on the back of that, because that means that the Fed is already beginning to think of tightening monetary policy. This slide here is a little bit more involved, and it goes through, and this is something that we will happily send and distribute after the call, but this goes through the inflationary expectations. Both CPI and PCI saw significant increases in April. Core CPI and PCE hit the highest level since the early 90s, and core CPI month over month hit the highest level since 1981. So inflation, and I know Adam will talk about this a lot more from the commodities perspective, we are seeing inflation creep up significantly over the last month or so, and that could continue, especially when you're looking at food prices and energy prices. Wage inflation will be huge in that, so we'll keep our eyes on what's happening from an employment perspective. If employers are bringing more workers back, if workers see and expect inflationary pressures to continue, especially from a food and energy perspective, they may start to demand higher wages, and we may begin to see that wage inflation that we haven't seen or we didn't see in the last recovery. Another, I would say, contributing factor to this recovery being a little bit different than the last recovery from the housing and financial collapse. Housing prices are hitting at record highs, and I think that we're dealing in a little bit different environment than we dealt with in the past. Part of the reason that we're seeing some strength is that savings rates are higher. So the American consumer has more saved to the side than they had in the most recent. We're also seeing some of that money being deployed into the stock market. So stock markets are at record highs, and we're seeing the move out of the correction and the COVID-related recession significantly stronger, because we do have consumers putting their money to work in the right places. So from a rates perspective, on our side, what are clients doing? They are locking in hedges and interest rate hedges on the back of what we're seeing. Like I said, inflation is a buzzword. We're talking about it every day, pretty consistently, and there is some fear around inflation. We haven't seen it sustained just because we haven't had time to see it sustained. But the question is do you want to buy the rumor, sell the fact? Do you want to be on the waiting side of things? Because the markets are always going to move in advance of an actual Fed move. Once the Fed dictates and determines that they're going to taper and tighten monetary policy, longer term rates will have moved in advance of that. So we're seeing a lot of our large corporate borrowers issue debt in the fixed rate market, in the investment grade and high yield fixed rate market, but also they're executing hedges on their variable rate loans. This slide here, I want to sort of key in on the bottom right-hand corner of this one. It talks about the dislocation between the Fed expectations and market expectations. The Fed has said that they're going to keep rates on hold for a considerable period. You're already seeing some decoupling from the Fed as more members start to expect rates to increase. But that blue line shows how the Liveboard forward curve is already starting to move in advance of a Fed move. The Fed can move overnight and make a change in their policy very quickly. So the market's already saying that they want to outpace the Fed and don't want to be left behind. So there's a little bit of a dislocation there, and what will happen is when the Fed does decide they want to taper and make changes, they will be catching up to the forward LIBOR curve. Final slide, I would say, here on the market side of things is just how quickly the Fed tends to move. They don't move slowly, so when the Fed moves, they will move, and I think a pretty substantial manner to the longer term. As you can see in the far right-hand corner, the longer term rates being well above 2% to 3% as far as the Fed's expectations. And quickly, just want to talk about, before I pass it on to Adam, I want to talk about the Liveboard to SOFR transition. That is something that is industry-based. Happy to speak about it if there's some more questions about it later on. We are seeing some other alternative reference rates coming out. BSBY, Bank Yield Index, Ameribor are also coming out, but LIBOR will be phased out by June 30th of 2023. That is an industry base, not only from a derivatives perspective, but also from, credit card rates, et cetera, et cetera. But we are seeing a sustained movement towards interest rate hedges being priced against SOFR, being priced against BSBY as well. But this is something that the industry needs because we don't want LIBOR to be submitted by rates or submitted by institutions. We want them to be market-based numbers. We want our variable rates to be market-based numbers. So this is a welcome change in the trend, and happy to answer questions about it later on down the line. But I appreciate your time, and I'll pass it on to Adam.
Okay, before we do that, real quick, Cameron, I do have a couple questions.
Sure.
And they came in, but they may be something covered later on. Also, what are the long-term effects on the economy with a $6 trillion fiscal stimulus? Like right now, it seems okay, but what's the long-term effects of that?
Right now, it seems okay, but the expectation is that it will lead to inflation. And you've got two different factors here. You've got the Fed saying they want inflation. They want to see sustained inflation because they believe that they can address it. But you will see higher rates. And in my opinion, I would say you will see higher rates. And with that comes higher rates of payment from the Treasury on the bonds that they have to issue. So the longer term effects will be higher prices, not only from the consumer perspective, but also from a government perspective. And I think that will mean at some point some slower growth, and you could see, depending on how the inflation is addressed. If it comes with higher wages and stronger wages, then you'd also get a consumer who's spending at higher levels. So, but if you don't get that wage inflation and you have a $6 trillion balance sheet, then you don't get that spending that's necessary to keep the longer term U.S. economy running strong.
All right, thank you. And then one more. So you said that our savings are higher now as compared to the Great Recession. Is that because of the stimulus? Is there less debt per household? Are people just saving more? What has changed?
It's a combination of both. I would say the stimulus has been tremendous in helping households save money. And I would say not only from the perspective of the stimulus being used, I think when the stimulus has come, it came during a period where people were trying to revamp and figure out different things. I think that also you've got the unemployment benefits have been helpful in addition to that. But I think that's one thing that's been different. The last recession, most of the stimulus went to the automotive and financial sectors rather than to consumers. And I think that the fear of consumers with COVID being out there, potential loss of jobs, I think that you've seen a lot of folks paying off credit cards and using the money rather than putting it directly into the economy, saving money and just preparing for what could potentially happen next. So that's been, the stimulus has been very helpful. The unemployment benefits within the stimulus packages has been also very helpful.
Thank you.
Awesome. I look forward to more questions as they come in, but in the interest of time, I'll pass it on to Adam.
Good deal. Let me bring this over here to the right screen. Can you guys hear me all right?
Yeah, we can hear you just fine. Thank you.
Okay. Well, Emily, everyone, I appreciate the time today. Just a quick recap. My name is Adam Zetzer. I'm with the Commodity Risk Management Group, primarily focusing on the consumer side of the market, but our sort of overall platform does operate on both sides. We have a robust lending arm to the oil and gas space, and generally can transact in any exchange that's listed domestically speaking. When talking about commodities, there's really a bunch to say. So, for the sake of not going through each individual market, just want to give some high-level information around what we're seeing and ways to maybe manage that, and consume that information on a market perspective. If I'm looking at the screen today on, just where the market is year to date, crude oil prices are higher by about 42%. The refined space of gasoline and heating oil or diesel, gasoline's up about 55%, and diesel's up around 43%. The expectation as things unfold in the pandemic and markets continue to open up is that we'll likely see higher prices, similar to what we saw post financial crisis in 2008. One of the key factors specific to the energy space is the supply side risk. And one could argue that supply side risk is sort of fundamental impact across any real commodity as of today. But specific to energy, when you look at the international markets, you have the OPEC plus cartel, very, very tightly monitoring prices. They're meeting each month to review supply, and most recently announced that they're going to increase output by 2 million barrels a day. Even with that, the expectation is demand will significantly outpace that increase, and you'll continue to see prices, supported either in that, $60 to $70 barrel range, and potentially on a long-term basis up above $100 a barrel. Ultimately, crude at $100 plus, you're looking at a refined space of gasoline and diesel, both trading at somewhere near the high 280 to 320 range per gallon. That represents roughly a 40% increase over the current market levels. So, thinking about fleet operations, anybody that has an energy component to the business, certainly there is topside risk there. That you might be concerned with. When thinking about what happened post 2008, you had a more long-term run, and what crushed that long-term run in the energy space was that increase in supply. Domestically speaking, the pandemic significantly reduced the number of oil and gas producers in the U.S. So now on a current market level, you have far fewer players in that space managing a lot more supply. So the ability for them to manage what enters the market is a lot more focused now than it was before. When looking at the metal space, the same narrative would hold true, whether it's aluminum, copper, or nickel. All three of those markets have the potential to be tightly supplied as we transition in the U.S. to a more electrified and digital age specific to transport. There are a lot of questions out there around whether or not the market can actually supply the potential need to facilitate that kind of transition. And certainly if we move towards that in a more aggressive manner and the supply is not there, you'll likely see higher prices in the metal space as that kind of global effort continues. The supply side risk, again, there is also something that we're talking to folks about. Reduced emission campaigns in China and lower output from the mines in Peru and Chile, specific to aluminum and copper, are kind of key metrics there that we're watching closely. A lot of headline risk there has started to move the market. And if you get the headline plus then the fundamental, you've got a significantly volatile market ahead. With respect to kind of the spaces that we play in, can you guys see the commodity solutions page here?
Yes.
Okay. So as far as Fifth Third's capabilities, these are just some of, but not all, the markets that we facilitate and participate in. If there are concerns or areas that, folks have, I'm happy to take questions on that front. But to drill down just a bit further, when looking at that diesel and gasoline space, what you're looking at here is a 20-year history of what the market did, this kind of squiggly blue line. Obviously here being that 08 move lower, and then we transfer back to, that more kind of correction, if you will. The key piece here is, we remained at that $3 plus per gallon level. And then in 14, 15 through 16, you had what was referenced as the shale revolution. That was access to crude oil, flooded the market. We were oversupplied. We experienced a severe glut, and that crashed the market. We sort of worked out of that through 16 and 17, but the pandemic was kind of the nail in the coffin, so to speak, whereby, like I said before, you've got less producers currently in that space, and we've transitioned back to, kind of that upward movement here. The horizontal lines are just some rough indications as to where you could fix your exposure relative to that historical move. So when taking that line of thinking to what the future might hold, if you could lock in at below market levels and kind of seize that opportunity, that's the advice that we're giving to a lot of our clients. Managing that forward risk is going to be a key component to how everyone sort of transitions post-pandemic, and having, that certainty and proper risk management in place is something that, we're really entertaining a lot of questions on. The same method here is for gasoline. Just again, wanted to highlight what happened in the market, and if history repeats itself, the forward space, you could see a significantly higher level of market movement and volatility moving forwards. And this here is just sort of bringing it all home. This is, crude oil along with what happened in that refined space on an average per gallon level, through that transition period. So again, a lot of that advice and worry on the forward space are those conversations that we're having with our customers. Continued weakness in the dollar will certainly help support commodity prices. And then again, that tighter supply is really going to be a key driver relative to what the forward space looks like moving forwards. That's really all I had from a commodities front. Given all that we cover, I could certainly drill down and take everybody's day, but I want to be sensitive to the time.
Thank you for discussing that with us today. I am including right now the center's social media links, so please make sure to like and share those to be notified events that, such as these webinars that's happening right now, and other things that are happening in the family business community. And as always, we'd like to thank our sponsors, without whom events like this wouldn't be possible. Fifth Third Bank, of course, Eastman and Smith, Highland, William Vaughan Company, Raymond, Shoemaker, Lupin Kendrick, Skylight Financial Group, and Huntington. Thank you all very much. Have a wonderful day.